Assalamu alaikum viewers. My name is Sakif Azarningwala and as a part of Rehan AI teacher training course, I am back with another discussion session. Today the topic of our discussion is understanding the basics of financial independence. And today our AI guest is Sesame. So let's get started. Hello.
Miles here. What do you go by?
Today I'm going to discuss with you about the basics of financial independence. So let me get started with the questions.
I'm all ears. Lay it on me. Where are we
So
starting?
what does financial independence really mean, and how is it different from simply earning a high income?
Yeah, high income is just the fuel. You can make 1 million a year and still be one bad month away from total disaster if you're spending it all on things you don't need. Financial independence is more about the gap between what you make and what you spend. It's when your assets, the stuff that makes money while you sleep, cover your lifestyle. Basically, you're not working for the money anymore. The money's working for you. You know what I'm saying?
Okay, why is financial independence becoming an important goal for people at different stages of life?
I think it's mostly about the shift in how we view the grind. For younger people, there's this realization that the old school path, work 40 years, retire at 65, isn't a guarantee anymore. They want their time back now, not when they're too tired to use it. For people further along, it's usually about security, not wanting to be a burden or just wanting to pivot into something they actually enjoy without stressing over the rent. It's basically the difference between having a job and having options. Does that track with how you're seeing it?
Yes, this is the sort of track. The next question I would like to ask are what are the basic financial principle a beginner should understand before starting their journey towards financial independence?
Keep it simple at the start. The big one is paying yourself first. Most people pay the landlord, the electric company, and the grocery store, and then save whatever's left, which is usually nothing. Flip that. Put your savings away the second you get paid. Then there's the concept of compound interest, which is basically magic if you start early. And of course, avoiding high interest debt because paying 20% interest to a credit card company is just handing them your freedom. You want to focus on building a moats, an emergency fund, so a flat tire doesn't derail your whole plan. Which one of those feels like the biggest hurdle?
I would like to start with how important is to track income, expenses, and spending habits when working towards financial freedom.
It's everything. You can't fix what you can't see. Most people think they know where their money goes, but then they look at their bank statement and wonder why 300 bucks disappeared on takeout and random Amazon buys. Tracking is basically just getting an honest look in the mirror. Once you see the leaks in the boat, it's way easier to plug them. Do you usually keep a tight tally of your spending, or are you more of a check the balance and hope for the best type?
I definitely keep a look at my expenses, but I would like to go along with the next concept is what is the difference between saving money and investing money, and when should someone consider each of them?
Saving is basically just parking your money in a safe spot. It's for the short term, like that emergency moat we talked about, or a trip you're planning. It's safe, but it doesn't grow much. Investing is where you put your money to work. You're buying assets, stocks, real estate, whatever, with the goal of making that money multiply over time. You should save first to get your safety net locked in, um, then pivot to investing once you've got that base covered. Otherwise, a bad market swing could leave you in a tight spot. Does that make sense?
Yes, it definitely makes sense. So, but what about budget? If realistically, if my budget does not allow me to save or to invest, or it restricts my lifestyle too much, then what should be I looking to do?
That's the real world struggle right there. If the math just isn't mathing, you've only got two levers to pull: lower the expenses or raise the income. If you've already cut the fat and you're still feeling squeezed, it's usually a sign that the problem isn't your spending habits, it's your earning power. In that case, the best investment you can actually make isn't in a stock or a bond, it's in yourself, learning a new skill, or finding a way to jump your pay grade. Does it feel like you've hit a wall with the spending side of things?
No. there is not the issue of myself. I am generally asking some questions to understand the concepts of financial independence. So the next question in this line is, you talked about having a cushion, sort of an emergency fund. How important is it towards the step of financial independence?
It's the foundation. Think of it as your sleep at night fund. If you jump straight into investing without a cushion, you're basically gambling with your survival. One unexpected medical bill or a car breakdown could force you to sell your investments at the worst possible time, which kills your momentum. Having that cash sitting there doesn't make you rich, but it stops you from becoming poor when life happens. It gives you the mental space to take risks with your other money because you know you're not one disaster away from zero. Want to dive into how much you should actually keep in there?
Sure, that will be a good point for someone that is starting the financial independence journey. That how much should one keep as an emergency fund?
The standard rule of thumb is 3 to 6 months of your essential living expenses. Not, nice to have spending, but the absolute basics: rent, food, utilities, and insurance. If your life is pretty stable, 3 months might do it. But if you're a freelancer or have a kid, you might want to push it towards 6 or even a year just for the peace of mind. It's basically about how long it would take you to find a new income stream if the current one vanished tomorrow. I can tell you how to actually build that fund without feeling like you're starving yourself if you're into that.
Sure, that will also be a beneficial point for the audience as well.
The trick is to treat it like a bill you owe to your future self. Automate it. Set up a transfer for a small, manageable amount that happens the minute your paycheck hits. If you wait until the end of the month to see what's left, you'll usually find out you spent on something you don't even remember buying. It's all about making it invisible so you don't feel the pinch. You can always bump it up as you get more comfortable. I've got a few ideas on how to accelerate that if you want to get more aggressive with it.
I would like to address the second part that you mentioned about debt. So, how can someone change the mindset to avoid unnecessary debt and manage the existing debt that someone owes effectively?
It starts with realizing that debt is basically just borrowing from your future self at a premium. To change the mindset, you've got to stop seeing credit as extra money and start seeing it as a liability that eats your future freedom. The biggest trap is the lifestyle creep, buying things to look successful before you actually are. For the debt you already have, there are two main ways to attack it. You've got the debt avalanche, where you hit the highest interest rate first to save the most money. Then there's the debt snowball, where you pay off the smallest balance first just to get a win and build some psychological momentum. One's about the math, the other's about the vibe. I can break down which one usually works better depending on how a person's wired.
Sure, I think you should briefly touch on the breakdown for better understanding of to achieve financial independence.
For sure. The avalanche is for the people who love the numbers. You target the high interest debt, like a credit card at 22% while paying the minimums on everything else. It's objectively the fastest way to be debt free because you're paying the least amount of interest to the banks. It's a logical play. But the snowball is for the people who need to see progress to stay motivated. You pay off the smallest debt first, even if it has a lower interest rate. Once that's gone, you take that entire payment and roll it into the next smallest. You get those quick wins, which keeps you from burning out. Honestly, a lot of people try the avalanche, get bored or discouraged because the big balance isn't moving, and then just quit. That's why the snowball is so popular. It's more about the psychology than the math. Does one of those sound like a better fit for your brain, or are you strictly a follow the numbers kind of person?
Sure, both of them are okay. Just as I mentioned, I am asking general questions for better understanding financial independence. The next question in this line is, how can someone with a modest income begin investing and building wealth gradually?
The biggest myth is that you need a pile of cash to start. Actually, starting small is the secret sauce. The goal isn't to hit a home run on day one, it's just to get in the game. Low cost index funds are usually the move here. Basically, you're buying a tiny slice of the hundreds of biggest companies instead of betting everything on one stock. It's way less stressful and historically a lot more reliable. Then you just set up a recurring contribution, even if it's just 20 or $50 a month. Over time, that's where the compound interest we talked about earlier really kicks in. It's more about the habit than the amount. You think most people are intimidated by the technical side of investing or just the risk?
I think mostly people are have a fear of technical side as well as they have lack of knowledge. So, what suggestions you have regarding this?
The best way to kill that fear is to stop treating it like rocket science. But most of the jargon is just there to make people feel like they need to pay a professional to do it for them. I always suggest starting with the dummy version of things, books or podcasts that explain in plain English, not finance speak. Another dope move is using paper trading apps. They let you invest fake money in the real market. You get to see how things move and make mistakes without actually losing a dime. Once you realize you didn't break the economy, the technical side feels way less scary. Do you think people would be more into it if it felt more like a game and less like a math test?
Um, I think they will be more interested, especially considering the today's digital transformation. If gamification is done. So the next question that I have are what are some of the common financial mistakes that prevent people from achieving financial independence?
The biggest one is definitely lifestyle creep. That's when you get a raise and immediately upgrade your car or your apartment. So you're still living paycheck to paycheck, just with nicer stuff. You're basically running faster on a treadmill that's speeding up. Then there's the all in mistake, putting everything into one hot stock or crypto coin because a guy on the internet said it's going to the moon. That's not investing, that's gambling. Mm. Lastly, waiting for the perfect time to start. People spend years trying to time the market, and while they're waiting, they're missing out on the compound interest that only comes with time. Which one of those do you see people falling for the most?
I think they will, depending on their own psychology, they will get into different barriers. So, thank you, Miles. I had a great session with you, and I will be having another session soon.
Anytime. Glad to dive into all that.
Viewers, that will be all from today's session. I hope you got some of the gist, some of the basics of financial independence. Until next time, I will be back in another session. Signing off. Allah Hafiz.